Hey guys! Welcome to the channel. In this video we will discuss how debt can ruin companies. So let's jump into the topic. Too much debt can be detrimental to a company for several reasons. Increased financial risk. When a company takes on a significant amount of debt, it becomes more financially leveraged. This means that a larger portion of its earnings must go towards servicing debt payments, such as interest and principal repayments. If the company's cash flow is insufficient to cover these obligations, it may face financial distress. Higher interest expenses. Servicing debt comes with interest payments. High levels of debt mean higher interest expenses, which can eat into the company's profits and reduce the funds available for reinvestment, expansion, or dividends to shareholders. Reduced flexibility. Companies with excessive debt may find it challenging to adapt to changing market conditions or take advantage of growth opportunities. Debt can limit financial flexibility, as it requires regular payments, leaving fewer resources for strategic initiatives or handling unexpected expenses. Credit risk. When a company accumulates too much debt, it may face a higher risk of defaulting on its obligations. Creditors may become concerned about the company's ability to repay, leading to increased borrowing costs or a downgrade in credit ratings, which can further strain the company's finances. Loss of investor confidence. Investors may become wary of companies with excessive debt levels, as it signals potential financial instability. A declining stock price or loss of investor confidence can negatively impact the company's ability to raise capital through equity offerings. Reduced valuation. High levels of debt can depress a company's valuation. Investors often discount the value of a company with significant debt, as they perceive it as riskier compared to a debt-free or low-debt company. Potential for bankruptcy. In severe cases, excessive debt can lead to bankruptcy or insolvency if a company cannot meet its debt obligations. This can result in the liquidation of assets and the closure of the business. Strain on operations. The need to allocate significant resources to debt servicing can divert attention from core business operations and hinder long-term growth and competitiveness. Covenants and restrictions. Many debt agreements come with covenants and restrictions that limit a company's ability to make certain financial decisions. This includes such as taking on additional debt, paying dividends, or making major capital expenditures. Violating these covenants can have severe consequences, including accelerating the repayment of debt. Market perception. High levels of debt can negatively affect a company's reputation and how it is perceived by customers, suppliers, and partners, potentially impacting business relationships. While some level of debt can be a useful financial tool for growth and expansion, it should be managed carefully to ensure that the company can comfortably meet its obligations and maintain financial stability. Companies must strike a balance between debt financing and equity financing to optimize their capital structure and reduce the risks associated with excessive debt. FAQ section. Why is too much debt considered a problem for companies? Too much debt can be problematic for companies because it increases their financial risk and can lead to a range of financial challenges, including difficulties in meeting debt obligations and limited financial flexibility. 2. And how does excessive debt contribute to it? Financial risk refers to the potential for a company to encounter financial difficulties or even bankruptcy. Excessive debt increases financial risk because it obligates the company to make regular interest and principal payments, which can strain its cash flow. 3. How does high debt affect a company's profitability? High debt levels can reduce a company's profitability by increasing interest expenses. These expenses reduce the company's net income, leaving less money available for reinvestment, dividends, or other strategic initiatives. 4. Can too much debt limit a company's growth and flexibility? Yes, too much debt can limit a company's growth and financial flexibility. Debt payments can consume a significant portion of the company's cash flow, making it challenging to fund expansion, research and development, or adapt to changing market conditions. 5. What are the consequences of a company's credit rating being downgraded due to excessive debt? A downgrade in a company's credit rating can lead to higher borrowing costs, making it more expensive to obtain additional financing. It can also reduce investor and lender confidence in the company, potentially making it more difficult to raise capital. 6. Are there any restrictions or limitations associated with excessive debt? Yes, many debt agreements come with covenants and restrictions that limit a company's financial flexibility. These can include limitations on taking on additional debt, paying dividends, or making significant capital expenditures. 7. How does high debt impact a company's valuation? High levels of debt can depress a company's valuation in the eyes of investors, as it is often perceived as riskier compared to a debt-free or low-debt company. This can result in a lower stock price and reduced market capitalization. 8. Can excessive debt lead to a company's bankruptcy? Yes, in severe cases, excessive debt can lead to a company's bankruptcy or insolvency if it cannot meet its debt obligations. This can result in the liquidation of assets and the closure of the business. 9. Is there an optimal balance between debt and equity for a company? The optimal balance between debt and equity varies by industry and the company's specific circumstances. It is crucial for companies to strike a balance that allows them to leverage debt for growth while maintaining financial stability. 10. How can companies manage their debt levels effectively? Effective debt management involves careful planning, monitoring of financial ratios, and considering the company's long-term financial goals. Companies should assess their ability to service debt comfortably and make informed decisions about debt financing. Thanks for watching. Don't forget to like and share. Please make sure to subscribe the channel for regular videos.